Are the bears about to make a serious comeback? Stocks took an absolute beating today with the S&P 500 down 1.5% on what was weak labor data, weak consumer confidence data, and the market getting defensive ahead of FOMC. So is this the end of the road for the bulls? Today, we're going to discuss that and earnings season. We'll talk about some notable names that reported earnings today, as well as how our indices holding up in this earnings season. We're also going to talk about some key data points and the consumer. Has the fundamental picture changed? Is the consumer weakening? We got a lot to talk about. Let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. Guys, we are trying to get 10,000 subscribers in May. I believe we have about 8,700 right now. We need 1,300 subscribers in May. So go ahead, subscribe. That is 43 subscribers every single day. Let's do it. Let's get it. Subscribe, hit that notification bell, like this video, and leave a comment, guys. It really helps me out. Let's get into it. An ugly day to end a ugly month. Very red across the board. Look at Amazon, Apple, Google, Microsoft, Nvidia. These were all down 1, 2, 3% on the day. The only spots of green had to do with earnings. Look at PayPal, Eli Lilly, stuff like AbbVie, which were running off the Eli Lilly news. And then we had this small section right here in consumer defensives. They were green. Other than that, a very red day across the board. Like every single sector lost on the day. The best performing sector, healthcare, lost 0.07, so pretty much flat on the day. The worst performing sector here was GDX, but you know, if we exclude GDX because it's not part of the 11 S&P 500 sectors, XME, metals and mining was actually down 3.45%. And again, today felt like a liquidation. I mean, there was a tad bit of rotation, I guess, into staples and healthcare, but at the same time, people were pulling money out of those sectors as well. So just a complete liquidation today, last day of the month, to cap off what was a terrible April. But let's hop on the charts and discuss everything. Now guys, this is the S&P 500, the monthly chart. So we can see the month is officially closed out, the month of April. The S&P 500 is down 4.16%. Here on the ES for the month, down 4.55%. So a very brutal month for both the futures market and the spot market. Incredibly brutal month actually, and first red month of the year, first red month since October 2023, but we're going to break down that later. Let's actually have a look at what we did on the day. Down 1.575% was the S&P 500, and guys, every asset was down today. The Nasdaq 100 down 1.92%, same with the RSP, mid caps, small caps, IWM. We can actually see these markets coming under pressure in the after hours as well. Look at the SPY down 0.26% here after a 1.58% down day. So it does look like a gap down is on the horizon, and a lot of this actually had to do with some of the data that came out today. We got like consumer confidence data, as well as some employee data, employee cost data, and I think the market was selling off on that news because of stuff like NFP that's coming out this week. So, you know, the market just getting a bit jittery. We also saw that at the same time, bonds did fall on the day, which means yields did rise ever so slightly. We can see yields were actually up in a very big way here on the day. That didn't help stocks. And we also saw the dollar did gain. That was not supportive of equities. Gold actually did fall on the day. So, you know, gold coming under pressure, again, making a lower low, very similar to Bitcoin. Crude did fall on the day as well. So commodities did take it on the chin, as well as Bitcoin. Let's talk about the S&P 500. Let's look at it from the monthly chart. So we did fall 4% for the month here in April. Very rough month. Okay. However, we are in the context of an uptrend, as you can see, and we do have to take into consideration this is the first down month for the year. So not uncommon. We normally get 2 to 3 down months in the S&P 500 every single year. Completely normal. Now on a monthly chart, guys, this is the very first level I want to look at as a pullback zone. So look, unless we actually go ahead and actually break this zone right here, that's when I will probably get bearish on a monthly chart. Until that happens, I think we can trade all the way to right here. And I think bulls are going to find support at this 47.74 level. So, you know, on a monthly chart, even though this looks bearish, right, you see this, and it probably means we might go lower. We might see continued weakness here in the month of May. You do have to understand it. Markets do pull back. That's completely normal. And if we actually measure from a peak to trough to this section right here, 9.11%. So if we actually do go lower, right, that's completely fine. As long as we stay above this 47.74 line on the monthly, we're actually constructively bullish and we can go make new all-time highs. So this is the very first line I want to look at. It's about a 10% pullback from there. It's about another 5% to get to this level right here. And if we do actually have another brutal month like we did in April here in May, that's completely normal. Now let's actually pull up on the weekly chart, right? Because it does get a little bit different on the weekly chart. Now a key support level on the weekly chart that I'm looking at is probably this level right here, okay? The 49.25 level, the same level we've been looking at all week. Let's actually just make that a different color. Now we are not too far away from this level. As you can see, we actually sort of did bounce. We didn't quite get to the 49.25 level. We did bounce ahead of it. We can actually pull all the way back to this 49.20, 49.25 level and still be bullish. The problem is, if we do break this 49.25 level, that actually does open the monthly level of 47.74, and then we actually can see downward momentum to this level right here. However, we're not yet there, and we do have to look at this 49.25 level as the first key level of support on the weekly chart for us to go higher. So constructively, we're still looking for a reason to become bearish on the weekly chart. We're looking for a reason to become bearish on the monthly chart, and the weekly and the monthly still look constructive for higher price action, new all-time highs, for us to find support here or anywhere between here and 49.25, and then go higher and break some of these highs, go break new all-time highs. However, the daily chart is the price action I am just not liking. Extremely unconstructive price action. This is a very red candle. I think it was a whole amalgamation of things today with regards to data, currencies, what the dollar did. It all came together and led to just some overall selling pressure. But we do have to understand that this is really the low we're looking at for the week, this 525, 5,000 level, and we're not yet there. We may actually go ahead and break that in tomorrow's trade, sure. But as it is right now, we look at the S&P 500 right now, and as we look at this, on a daily chart, we can say, okay, we've put in a higher low. Can we go lower? Yes. Can we actually bounce from here? We definitely can. We do have to understand that we are in the context of this daily downtrend in the S&P 500. We did actually go ahead and break these highs, but we've put in a lower high relative to this high right here. So what we can actually see is that we've pulled all the way back. We've had a relief rally, and now we're moving lower. Now we do have to go and break this low right here for the bears to really start to take over and algo flows to come in, and then these lows on the way. That does coincide with our 49.20, 49.20 level we're looking at right here. So, we're in a very critical zone for the bulls because we have a daily support level here that could actually coincide with some of these levels breaking to the downside, making lower lows. So, if bears don't support the price on the way here or at the 49.25 level, it will look like we put in a lower low relative to this low. If we do continue low, and that probably means we are going to see further downside to as low as the monthly support level here, 47.74 during the month of May. So unconstructive price action on the daily chart. That do take it into context. On the weekly chart, everything's looking good. There's no technical damage on the weekly chart just as of yet. And on the monthly chart, things are looking as healthy as ever. It's just on the daily chart, when we do start to break down with where these levels are, with where price action currently is, and us forming what looks like a lower high, this price action is looking not that constructive for higher prices on the daily chart. But again, the weekly chart and the monthly chart are completely fine. So what happens next? Well, it really depends. So we're going to have to see what happens with this price action over the next couple of days. Where will we actually find support? Will we find support here, move higher? Will it be here? Will it be at the 49.25 level, or will we just slice through these levels very, very quickly? That's what we really want to find out. Maybe this was just end of the month selling, end of the month window dressing. We don't really know, and then we could actually definitely rally from here. It's really hard to say with these end of the month flows and with such important points of data looking forward. But as it is right now, I do see the 49.25 area as a key line of support, and nothing has changed from this right here, the 49.20 area all the way to the 5,000 area right here. Okay, that is the buy zone. This is where you definitely want to be buying stocks. And like I said, it does get a bit scary when we do get below here, but if we do pull back, anywhere in this zone is the very first buy zone. It's a 5% pullback, peak to trough, and that's normally what you want to do. You want to buy those 5% pullbacks, and then the next 5% pullback zone is actually like right here. Okay, so we can pull back, move lower, and then we have a great buy opportunity right here, have a great buy opportunity right here. This would be a 10% pullback, peak to trough, and then we can definitely find some great support below the 47.74. So the plan remains as is. We want to look for buying opportunities right here, anywhere from 49.25 to the 5,000 level. If we do get below the 49.25 level, that's when I will update you guys as to what happens next. Let's talk earnings, guys. We probably have the most densely packed day of earnings this week. We have pretty much all household names. McDonald's in Australia, we call it Macca's. Coca-Cola, PayPal, 3M, Amazon, Supermicro, AMD, Starbucks. But today we're going to pay close attention to Amazon right here because it's part of the Mag 7, as well as PayPal because there's a lot of buzz around it. And I also am a PayPal investor. Let's talk about PayPal's earnings. So very good earnings, guys. They beat on sales. They actually missed on the streets earnings per share guide. However, if we actually look at the non-adjusted EPS, when they included stock-based compensation, it actually didn't beat despite what the street wanted. It was actually 18% year-over-year growth in EPS. So, EPS is growing, especially on the adjusted figures. The company officially reported a trailing 12-month free cash flow of $5 billion. They reported $1.86 billion in free cash flow for the quarter. Very, very good. In my personal opinion, this was a triple beat. Despite what this EPS number shows, I think they actually beat on EPS, and growing EPS 18% is exactly what you wanted. They kept guidance same as prior for both Q2 and reiterated financial year 2024 guidance. I hopped on the earnings call for about half of it. I didn't listen to everything. There was some great things about the earnings call. The one thing I didn't like about this earnings was actually transaction margin. We thought margins were inflecting, take rate was inflecting. That is not the case. We actually had the lowest transaction margin ever at 45%. So, things not looking good in that front. But other than that, balance sheet is solid. The company bought back shares. They were up nearly 10% in pre-market. The only reason they were down is because the entire market came under pressure, or the only reason they were down from their highs was because the market came under pressure. And if we actually have a look at a quick valuation on PayPal, this is the current price. So we put the new free cash flow figure in here, the 7% growth rate, right? A discount rate of 11%, perpetual rate of 2%. We put the cash flow debt right here, the new shares outstanding divided by the equity value. We actually get a fair value now of $101. And I do believe my last valuation was about $89, maybe $90. And that's because free cash flow inflected in a very big way. We went from $4.2 billion in free cash flow for the trailing 12 months to $5 billion in the last trailing 12 months. That puts our fair value now 33% under this current price. And I do think PayPal is a serious buy at these levels. You want to know what's crazy about this number right here? The growth rate, the previous growth rate I was using was 9%. I'm now using 7%, and we actually moved up in fair value. So great opportunity here for PayPal for those that didn't get in. And I do think this is going to re-rate in a serious way. I think we just have to get past all of the seasonally bearish flows we're currently in. Other earnings we saw today, Amazon, I didn't dive deep into it, but there was a couple things I saw. They missed on their Q4 revenue guidance, but they beat on sales. They beat on EPS. They were actually up 1% in after hours. And I do think now AWS is a $100 billion per year business. So a real growth driver, a high margin growth driver is the AWS segment here of Amazon. A couple of other earnings, guys. We saw SMCI. SMCI raised guidance 3% and they were actually down 12% in the after hours. But I think they beat on EPS, missed on revenue. AMD was down 7%. I didn't look at their earnings, I just saw the chart. Starbucks earnings was absolutely horrendous. And there's definitely a slowdown happening because of the Middle East and China right there. So Starbucks was down like 12%. It was horrendous price action. I may actually do a valuation on all of these stocks on my Twitter, guys. So go ahead, subscribe. I've been doing stock valuations, my fair value, and very, very interesting take. So I'm going to do valuations for every single company on this list here today, including Coca-Cola, PayPal, 3M, McDonald's, the whole 9 yards. So during these dense earnings season weeks, we look at the earnings scorecard. Now, I happen to get the data of the S&P 600, and small caps continue to just be a terrible sector to have your money from an earnings basis. It might be different from what's happening on the charts because a lot of this could be priced in, but what's happening in the year and now in earnings, a proper dumpster fire. So 165 companies of the 602 have reported negative 24.4% growth, guys. The only positive earnings sector here is healthcare. And if you know anything about the S&P 600, right? There's a ton of biotechs here in the healthcare space. So biotech's holding up small caps together, and that's how you know this market is hanging on by a thread. The sales growth right here, the positive sectors include financial, and utilities. The sales growth doesn't look too bad. Actually, comm services, 28% growth here. So the sales growth doesn't look too good. It's just when it gets to the earnings section right here, and I think a lot of it has to do with credit quality. These companies can produce great top line, but because they have a lot of floating rate debt and they are smaller companies, so they don't really have pricing power. They have to cop a lot of these expenses on the chin. It comes directly off the bottom line. And that's why we're seeing sales growth, which again is still terrible, but not as monstrously bad as the earnings growth. If we look at beats in aggregate, 63% of companies are actually beating in the S&P 600. That's not bad. Then we actually have a look at 39% with sales beats. Again, probably below the historical average, and then beat on both 21%. Again, not very good when you look at it. However, if we do dive into the specifics, we can actually see that if we exclude energy on the sales front, we're actually reporting 0.09% sales growth and then negative 21.6% here in earnings growth. So guys, a proper dumpster fire. If you didn't know what a dumpster fire looked like, this is it right here. Feast your eyes. Let's just be lucky we don't get to smell the dumpster fire, because that would be terrible. But these are the earnings, not looking too good. But you do have to understand that the S&P 600 trades at 12 times. And I do think that a lot of this is already priced in. Now looking at S&P 600, and a sight for sore eyes after looking at that, but not much has changed from yesterday. In fact, nothing has changed. We're still reporting 5.6% growth here in the S&P 500, 3.8% revenue growth. The same is true here for energy and extra BMY adjustment. And at the start of earnings season, it was 3.5%. As you can see, we are tracking slightly above the consensus, which is really, really good. So the big one, the big boys, the markets that actually matter, the ones with pricing power, the ones where probably most of your money is invested, they're doing really well this earnings season, actually beating consensus. And that's exactly what you want to see. Now let's actually have a look at S&P 500 surprises, guys. This was very, very interesting, right? So we're going to look at this right here, the absolute surprises, and then we might have a look at revenue. So information technology, 99% of technology stocks so far are reporting positive earnings, only 1% negative. The same is true here for communication services, consumer staples 94%, healthcare 94%, industrials 88%. The only sector below a positive surprise of 50% is this right here, energy, 42%, and they're reporting 49% negative absolute surprises. Now the average Q1 surprise is actually 9%, and this is really, really good. And if we look at the revenue side, now they just give us the standard deviation, but we can see that 53% positive surprises, only 11% negative here. So very, very good stats right here. And we can see that the average revenue surprise is 1%. And if this data continues to unfold for the rest of the 230 companies that do have to report, it's going to be a very good earnings season. And this just sets us up for, I would say, all-time highs, because earnings are coming in really, really good. If they continue to come in good, the S&P 500 will continue to move higher. At the end of the day, the only thing that matters is earnings. Are they coming in good? Are they coming in line? And if they are, stocks will move higher because they become cheaper on an earnings basis, and that's exactly what you want to see. Now let's talk about valuation, and we're going to look at quality factors, guys. So you can see here that quality factors trade at a valuation premium versus its history. High margins versus low, strong versus weak balance sheets, high returns versus low returns. So this would be stuff like return on assets, return on invested capital, and then low volatility versus high volatility. So these are considered the quality factors, and they're trading at a valuation premium with ultimately growth, high versus low growth at the highest valuation premium against stuff like momentum, valuation, size, and dividend yields. If you guys are looking for value, even value at a reasonable price, I definitely would start here in momentum, right? And valuation, because you can definitely get good stocks that will get you outsized returns, and that actually might trade at a good discount, and that the market may re-rate in the future. That being said, this is valuation right now, and if you want these high quality stocks, you're gonna have to pay up a bit. It's simply the market environment we're in right now. Now let's talk a bit about the economy, guys. So on Friday we get non-farms, a very big print. Now we are expecting 250 non-farms. I know it says 350 right here, I made a typo. 3.8% in the unemployment rate, 0.3% in average hourly earnings month over month, and we can actually see here that hiring has accelerated in 2024, and will it continue? For the last 3 months we've had crazy upside surprises in the non-farm employment, and this is the reason why the economy has remained largely robust. And we will see if this continues to accelerate, because that will hurt inflation. But you know, this strong economy and this increasing labor market is the reason why I showed you guys these stats yesterday. It's the reason why disposable income and employee compensation are actually tracking above inflation and are tracking very, very strong. And it's the reason why real personal consumption continues to remain strong. People have jobs, they're getting paid well, and therefore they're spending more money. At the same time, looking outside of the consumer, looking at manufacturing, this is just a note from BOFA, and we're going to read it. They say, week ahead, playbook for a big macro and earnings week. Now, PMI expansion continues. buy financials. The manufacturing recession has ended. Leading indicators suggest a continued upcycle. We expect the ISM PMI to print at 50, but higher for longer interest rates could limit upside from supportive fiscal policy. During the first 3 months of expansion, the S&P 500 gained 93% of the time, 6% on average. Financials has been the best performing sector, along with consumer discretionary, materials. Tech lagged. See Exhibit 8. This is the S&P 500 during historical PMI expansion cycles, as you can see right here. So when PMIs have troughed, the S&P 500 has actually gained after we've had that PMI manufacturing recovery up to 24 and 36 months later. You're looking at anywhere from like 20 to up to a 40% gain in the S&P 500 2 to 3 years later. And this is a really good sign and a tailwind for equities as a whole. At the same time, what's also driving this PMI expansion has to actually do with CapEx. Companies in the S&P 500 are guiding well above the consensus on CapEx. We actually saw that with Meta. That's part of the reason why they got sold off heavily last week despite stellar earnings. And we can see here that this is the average guidance ratio companies are reporting right here. This has to do with AI as well as just a general CapEx cycle that we've been needing since even before the 2020 situation, the pandemic. And I do think that this is going to continue for quite a number of months, and it is going to support S&P 500 earnings through to 2025. Now guys, looking at market breadth, this is breadth for the S&P 500, 400, 600. And all in all guys, one thing we can definitely take away from market breadth right here is that these shorter term or medium term breadth metrics kind of look messy. You know, current 1 day ago, 2 days ago, they're looking pretty healthy. 6, 7, 8 days ago, they're looking not that healthy in terms of percentage of stocks above their 50-day moving average. However, if you do look at the longer term breadth metrics, 200-day moving average, percentage of stocks above. But if you look at the longer term breadth metrics, percentage of stocks above their 200 moving day average, it looks very, very healthy. Even at the current 1 day ago, 2 days ago, and then 10, 9, 8 days ago. And that is true for the S&P 400 right here and the S&P 600. Although the S&P 600, we can actually see just a little bit of breadth coming under pressure. Although ultimately the S&P 500 breadth is the strongest of them all, and the weakest breadth is the S&P 600. And that's because these companies, their earnings are not that great. Mid-cap earnings are actually doing pretty good, but S&P 500 earnings are the major driver of flows in this market right now. Now guys, let's actually look at a bit of seasonality. This was a very, very interesting chart, and it is just various S&P 600 6-month returned factors. So we can see here that May to October is actually the worst time period to be invested. Nonetheless, you still actually get a positive return, 1.7% in these 6 months, and 64% of the time you will end up higher. And we can actually see right here that November to April, October to March, December to May was actually the best period. So we were just in the best possible period that we could be in for stocks, and we've had a fantastic October to sort of like middle of April. It was a fantastic run, 20, 25, 30% plus in the S&P 500, and you can actually see this here with the average. We are now moving into the weakest time period in the year, and so do expect volatility, and that is something we've definitely been seeing. As you can see right here, this is the S&P 500 through to the 4th of the 26th, and yeah, we have pulled back in a very material way, but when compared to the average election year, we are tracking well above the average election year. However, trend is more important than level, and you can actually see that from about this area right here all the way through to June, we normally just trend sideways in the S&P 500. And for a market with quite a lot of volatility like we've seen, sideways for us may actually be this type of chop before we then sort of make a bottom around this May-June area and then continue the upward momentum cycle. So do expect quite a bit of chop here in the S&P 500. It will form a bottom and then we'll rally for the rest of 2024. Guys, I still believe the melt up is truly underway. We will go higher in the S&P 500, but the market is just doing a bit of digestion as well as getting valuations back to the norm, especially as we roll through earnings season. Now looking at my models, this is the core leadership model, and we went from strong leadership just teetering on weak leadership very, very quickly, but we are back above the zero line, and this is still a risk on environment. We've actually seen a very similar thing in the core market model. We did see a massive swing downwards from the overbought level. However, we are above the zero line, and I do like the core market model more. It's just less sensitive to shorter term metrics and it looks at more longer term breadth metrics and technicals. And you know, in both areas we are above the zero line, and this is still a risk on environment. So any short term weakness, guys, you do just want to buy the dip because we are still in a very, very risk on environment. And actually, this model right here, it's very hard to get below the zero line. But when we do get below it, can actually see quite a lot of weakness. So we don't want this below the zero line, especially in the core market model. Now, data in the week ahead, guys, we spoke about this earlier. The big one is going to be on FOMC, but we do have a couple of important things. ADP employment tomorrow, as well as the PMIs and then JOLTS. So we do have to keep a strong eye on the employment data. The second the labor market starts weakening, that's not going to look good with the GDP figures, with the PCE figures we just got. And then we have the big one, non-farms, as well as trade balance later on in the week. Guys, but if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.